Good to go? Okay, good morning. Today is January 17th.
Looks like you're still filling some chairs there.
Kelly, will you take roll?
Yes. Jermaine Sullivan.
Here.
Liz Lasky.
Here.
Jeff Rowe.
Here.
Bill Gambo.
Here.
And Doug Parks and Ed Bradford have an excused absence today.
Thank you. Old business, Asher Oil royalties. Are we discussing that?
No, it's just informational. Really.
Okay.
On your second sheet.
Approval of minutes from October 18th, 2024.
I'll make the motion to approve the minutes from October 2024.
Support.
All in favor? Aye.
Yes.
Aye.
Motion passed.
Investment advisor update and commentary.
All right, we're ready for you guys.
Great, thank you. Well, I want to make an introduction to a new member of the team. You'll see a new face here, John Finkler. John joined Bartlett almost a year ago, and I don't know if we talked about this earlier. I did give Ed a notification recently that Troy Snyder, after I think it's like 83 years at Bartlett, is going to retire. And he's going to wind things down. He's been winding things down for a while, but as of the end of March, John will be taking over responsibility for all of the fixed income investments at Bartlett. And he's already kind of somewhat transitioned into that role and been making extremely valuable contributions. And he has great experience coming from Fifth Third Bank, where he had a key role in managing investments for the bank. So, John, if you want to say hi and share a few words, if you like.
Yeah, thanks, Woody, for the introduction, and great to be here with all of you. As Woody indicated, Troy and I have been working in the background here for the past 6 to 12 months, just on transitioning some of the responsibilities, and look forward to working further with all of you in the future. So thanks for having me.
Mayor, would you like us to get started with our presentation?
Yes, please. Thank you.
Great. Well, I think Kelly said that you all have a copy, hard copy in front of you, so we'll move over to page 4, which is kind of an overview of what we call the Bartlett's market assessment. And we have some positives and kind of negatives and some general thoughts. And I think the general thought is, overall, we have probably about some of the best economic conditions in our lifetime. I mean, it's rare that you get fairly low inflation, and you have low unemployment. You have an economy that's growing. You have corporations that are doing well, and that's a unique combination. And that's not, those things don't always last that long when you've got all those stars aligned like that. But right now, it all looks pretty good. The only downside for the investor is the market reflects all these positive conditions, and stocks, for example, are kind of not at the bargain level. They're probably what we would call fully priced, which means if corporate profits continue to do well over the next year, then the stocks start to look more reasonable. But it's somewhat dependent on no recession for 2025. And there's a lot of, as we all read in our local papers, there's a lot of prospective policy changes being considered with the new administration, whether it's immigration or tariffs or other types of, reducing the size of the government, all these kinds of things. A little bit of uncertainty about how all that plays out, but so that's kind of an overview. I don't know, Troy, if you wanted to add to any of that, or maybe kind of just maybe morph into the next couple of pages of the booklet.
Woody, I would just add that, the Federal Reserve embarked on lowering interest rates back in September and was able to do 100 basis points or 1% of cuts on the shorter Fed funds rate, and for good or worse, the economy has shown to be very resilient here. While we were thinking it would need a lot more rate cuts, I think the Fed is now looking at the data, and there's a chance they might cut one or two more times over the coming 12 months at this point, and maybe kind of take a slower pace here and see how the data is coming in. So I think it just kind of reinforces what Woody said, is that the economy's doing pretty well, and while everyone would like to see those lower interest rates, and all good that they can do, it may be that they go a little slower for a while to make sure that they're keeping their foot on inflation. So we'll talk more about that in a minute. John's got some slides on both of the Fed's dual mandate, actually. So
While Troy was talking, I just got a pop-up on my news screen from the IMF, which is projecting that the U.S. economy will grow at 2.7% this year, where their prior estimate was 2.2. That's quite a big increase. I mean, it sounds very incremental, but the way investors look at it, that's almost over a 20% increase in the rate of growth. And the IMF is a respected institution in terms of having credibility for making forecasts like that. So, to the point that we talked about, the U.S. economy looks to be pretty strong this year. I don't know if we need to dwell on any of these following charts. Troy, if you had anything you particularly liked, I know this one, page 6, is kind of interesting. Maybe you could comment on that.
yeah, sure. This is a chart that sort of the gorilla in the room here. The federal deficit, and it's no surprise or no secret that we've been spending more than we take in. 2024, I believe our deficit was, I think we spent about 1.6 trillion more than we took in, and it's projected to grow to 1.9 trillion this year. And so this chart on page 6 shows how much of that as a percentage is going towards interest expense, and it's been expanding as interest rates have been growing or rising, and also as our debt levels have been increasing. So the blue there is getting to be a bigger part of our overall deficit burden, and so it's a factor. The longer that runs like that, the more it's an allocation of resources challenge for the government, and it could cause things to the economy to slow down if we're spending so much on our debt.
A term that's frequently used, the term valuations, is frequently bandied about by investment people. And what it refers to is how are stocks, how are they valued in the marketplace, high or low? And so when people talk about valuations, they're basically, they're prefacing whether it's either high or low. And if we go to page 9, we have a few charts on valuations here, but page 9 is one form of that. And you can see that going back to the 1950s, that valuations are kind of on the high end. And so this is the price, the P divided by E, which is price earnings ratio. So if you think about it in terms of, if you took the market value of all the companies in the S&P 500 and divided it by the net profits, the net after-tax profits of all those companies, you come up with a ratio. And when the ratio is high, that means you're paying a lot for stocks, for the stock market. And you can see right now we're sort of in that higher end. It's not worrisome. It's only worrisome when it really spikes up really high, like we did, like in 1999.
So you're muted,
Oh,
Woody?
we lost you, Woody.
You're muted?
Can you hear me now?
Yes.
Sorry, but normally, so when that ratio, I don't know where you lost me, but that ratio of the market value of the S&P 500 divided by all the profits of the S&P 500 are kind of at a high level, but it's only worrisome when it really hits these high spikes like we get at 99 or 1980 or 1990 or 2000. But a lot of times that really is happening before earnings actually spike up too. So a lot of times stocks go up before the earnings go up. So anyway, it's something to keep an eye on. The next couple pages are similar statements or forms of presenting that. You can see on page 10, U.S. large cap valuations, that if you do a kind of a correlation study, you'll see that going back since 1978, that right now, based on where stocks are priced, that is anticipating a lower return on stocks over the next 10 years. So something like 4 to 5% from stocks, where I think we've been used to something much higher than that, maybe something closer to 8 to 10 for quite a while. And since we started managing for the oil and gas fund, it's as you'll see later, it's more been in the double digits, something in the low teens. So with that, I'm going to turn it over to John because, as you know, over the last year or so, we've focused on a special topic that we thought would be of interest to the board. Sometimes it's insights to the market. Sometimes it's maybe a little more educational about what's going on in the economy and the markets. And today it's a little bit of both. And so I'll turn it over to John.
Yeah, thanks, Woody. Appreciate it. I'm going to kick it off on slide 13, and we thought it'd be good just to remind everybody of the Federal Reserve, who they are, and really what their main goal is. We talk about the Federal Reserve's dual mandate, and this is very timely because, as Troy indicated here just a few minutes ago, we had the Fed embarking on their first rate cuts back in early September. And as we turn the calendar here into 2025, I think, the big question is how much, if any, can the Federal Reserve continue to cut rates in order to support really modest positive economic growth? So the Federal Reserve, that's obviously the central bank of the United States. They are tasked with conducting the nation's monetary policy, and their two main goals are to promote maximum employment and stable prices. And this is what we refer to as their dual mandate. And this was really given to the Federal Reserve back in the 1970s. Now, one of the tools that the Fed can use to achieve this balance between employment and stable prices is through adjusting short-term interest rates. And that's what we all hear about in the news. That's what we've talked about here just a couple of times. The big question that we ask ourselves now is, what will the Fed do next with interest rates? And we care what the inflation and the employment picture look like, because ultimately that drives what the Federal Reserve does with short-term rates, which ultimately influences our markets, both fixed income and equity. So we thought it'd be good to kind of dive into where we stand with those two measures, the dual mandate. So first, as you'll see on slide 13, is inflation. And we're graphing two different inflation measures on this graph. The first is the CPI, or the consumer price inflation. And then second is the PCE, which is the personal consumption expenditures. Now, they're both measures of inflation. Where they differ is how each are calculated and how each are weighted in the different price levels of goods and services. They each assign different weights to different categories of goods and services. So back about 10 years ago, the Federal Reserve judged that a 2% inflation rate over the long run is what is consistent with a mandate for maximum employment and price stability. Now, there's been debates about whether this is not only an achievable level, but also whether it's sustainable. So a 40-year average of 2.8% tells us that it might be difficult to achieve that 2% inflation target. And as you'll see, as this graph shows here, since really early 2021, 2% has been really a challenge to achieve. Now, COVID really set off inflation in 2021 because of the supply chain issues. And it was really mid-2022 when inflation peaked at over 9%. Now, in response to that huge surge in inflation, the Federal Reserve increased interest rates. And as you can see on this graph, because of the Fed's efforts, inflation has been steadily decreasing towards that 2% target. Now, nobody thought that the job from a 9% inflation target to a 4% target, nobody thought that would be difficult. But it's really kind of that last leg of getting inflation down from that 3-4% level down to that 2% level that I think has really proven more difficult than anyone believed. Now, we did just have an inflation CPI print earlier this week, and it showed that inflation was actually 2.9%. So we've kind of hit this plateau here. So we have to kind of ask ourselves, this is great. We have this headline inflation of close to 3%. What's really causing this kind of last bit of inflation, this lingering inflation, to get towards 2%? So if we look at slide 14, this graph's a little busy here, but what you're looking at are the underlying components to CPI, and they break it down between food, energy, goods, and services. So this far left of this chart dates back to early 2020, and then the far right is your most recent CPI print. Now, when inflation peaked in the middle of 2022, you can see that the pressure came from really all areas, but especially it came from food and energy. You'll see in those blue and those red bars, and that was really due to the shocks from the pandemic. We also had Russia's invasion of Ukraine, which really spiked energy prices. Now, you can see over the last few years, inflation in each of these two categories has slowed considerably. Although, if you look at the level of grocery prices in particular, that remains elevated, which obviously I think everybody here can attest to. And that's certainly a burden on many households. But the one bar that you can see, it's very apparent that really is dominating inflation still to this day is the services inflation. Things such as shelter, medical care, transportation like airfare, car maintenance, insurance prices, and also education. So now out of those service items that I just mentioned that make up that yellow bar, shelter or housing, said differently, is the biggest sticking point that continues to put pressure on the overall CPI rate. Now, the housing services are really impacted by several factors. You had a surge in the work from home back in the COVID times. And then you also had new and existing homeowners that were able to lock in historically low mortgage rates, which also drove up the demand for housing. Now, because of the run-up that we've seen in the housing sector for the past few years, it's really causing that piece of inflation to remain higher for longer. And if we look at, that kind of the outlook, the 2025 outlook for housing, I think supply continues to be a huge factor. I saw a stat not too long ago that almost 80% of all outstanding mortgages have a mortgage rate that's below 5%. So there's a ton of people out there with mortgages, if you have one, that are sitting on cheap money. And so they're not really going to be enticed to move out of their existing homes, and that's causing the supply issue in housing. So as we look forward with inflation, this services piece of inflation is something that we will continue to watch closely. But the key element here with the overall inflation rate is really the lack of continued progress. Like I said, it seems we've stalled out closer to that 3% level rather than the 2% level where the Fed would like to see it. Now, to keep that progress moving towards 2%, I think it's going to be in the Fed's best interest to maintain a higher for longer policy. But we can't forget about the second piece of the dual mandate, which is employment. So while maintaining stable prices is a concern for the Fed, they also have to concern themselves with a stable employment environment. So on slide 15, we can see where the U.S. currently has an unemployment rate of 4.1%, and that was actually just printed a few weeks ago. So throughout the last year, we've really seen some, I guess if you step back and look the past 25 years, 4.1% is really historically a low level. But if we were to zoom in on the past year, we started to see some early signs of weakness in the labor market. And by weakness, I really mean that the unemployment rate began to rise slowly, but it caught the eyes of policymakers. Now, it rose from a low of about 3.5% back in 2023, and it hit a level of 4.2% late last year. So it's kind of that rise that really caught the eye of policymakers. And because inflation was seemingly on a path towards that 2%, the Fed really switched their attention from inflation to employment. Now, because of this move higher that we've seen in the unemployment rate, policymakers deemed it appropriate to cut the short-term interest rates by 100 basis points to ensure stability in the labor market. Now, this unemployment rate of 4.1% certainly seems to have stabilized for now. And then finally, on slide 16, if we think about the prospects for continued strength in the employment landscape, kind of one of the things, many tools we can look at, but one of the measures that we like to look at is the job openings to the unemployment ratio. So this is simply taking the total number of job openings and dividing it by the number of unemployed people. Now, this result is it's a statistic of the number of again, job openings for every unemployed person in the United States. And this roughly reflects how high employers' demand is for additional workers relative to the pool of people actively seeking work. Now, you can see this ratio has clearly come down from its peak in 2022, where we had almost 2 job openings per unemployed person. At that time, you can easily say, employers were really desperate for workers as the economy was reopening. There was a pent-up consumer demand from the strained supply chains, and obviously that contributed to the higher inflation that we saw. But currently, the ratio stands at 1.2. So this normalization is partly the result of vacancies being filled by new workers entering the labor force. Also is partly a result of vacancies being eliminated by employers before they're filled. And that's really given pressure to, from higher borrowing costs. We've seen slower consumer demand. But for now, we continue to see demand from employers. So as long as this continues, we continue to like the prospect for a healthy job market. But certainly this is one of the areas that the Fed has their eye on here as we transition into 2025. So if you've ever heard the term data dependent when we're talking about the Fed, inflation, employment, these are the 2 areas that the Fed is most concerned with. And how these 2 data points really play out here as we get into first, second quarter of this year will really determine whether the Fed can execute additional rate cuts this year, and if they can, the amount of rate cuts that they can execute. So I'll pause there. If there's any questions, I'd be happy to answer them on the Fed's dual mandate, or if there's any additional questions on the macro environment, we'd be happy to field those.
Questions? Nope, no questions.
Okay, good. Thank you, John. We'll move on to the portfolio, and you can see on page 17 a snapshot of the oil and gas portfolio. And at the end of the year, we were just over 14 million, and we're pretty close to the targets in terms of diversification. If you look at the table there where it says percent portfolio versus the target allocation column, we're pretty much right spot on with stocks are about 65%, fixed income about 30%, and then we have some cash equivalents. And then the next page, you can see how we're diversified among stocks. I think in the past you've heard us say that we tend to have a defensive approach to our equity investing, which means that it's not an aggressive approach. So when markets do very well or they're very strong performance, we typically lag because we're not in the high flyers, the hot stocks, the high price stocks. We like a little more stability within our performance for stocks, and so that leads to that top bar, information technology. You can see we're underweight technology, and you'll see how that translated into the performance in a moment. And then things like healthcare, we're overweight. That's an area that's kind of perceived as defensive. It's kind of steady over long periods of time because what they spend on healthcare is not sensitive to economic conditions. But you can see generally we're very diversified, somewhat along the lines of the Standard & Poor's 500 as it relates to these 11 industry groups that are listed along the left column.
Page 19 is the profile of the fixed income portion of the portfolio. And if you walk through the table in the upper right-hand corner there, some key metrics. So the first column there, the Manistee portfolio, and then the benchmark there is to the right. That's the Bloomberg Intermediate Gov Credit Index. So the average maturity is just a little over 4 years, and the duration, that's an interest rate measure, is consistent with that average maturity, really. And then the yield to maturity, 487. We're a little better than the benchmark, which is 477. And then we're A+ credit rated overall. That means we've got some AAA and AA, but we've also got some BBB bonds. And then the benchmark is a AA+. It's got more treasuries, which are AA rated, and that's kind of where that comes from. If you look to the left, I'll just walk through these charts briefly. The maturities are spread out, really 1 to 10 years for the most part. You can see there where the Manistee portfolio is in blue. And so we've got good representation in the shorter bonds, the 1 to 3 year, but we've also got a pretty good weight out there in 7 to 10 years right now. And as interest rates have moved higher, it's kind of made sense to get some longer bonds in the portfolio over the last year. And but we also have some bonds inside of a year that'll be maturing soon too. So those will be redeployed and reinvested somewhere in the portfolio where we see the best yield. The lower left is just a breakdown of what the sector allocations are. The corporate bonds represent the largest part of the portfolio, a little over 50%. Down a little bit from over a year ago. The treasuries are not quite 30%, and we've been kind of adding to those as interest rates have grown over the last year. And the mortgages is another area that we've liked and we've added to over the last year. So, we're seeing good opportunities in fixed income. The yields are so much better than they were going back to 2021. The yields were under 2%, and now we're working with yields of 4.5 to almost 6. So things are much better in the fixed income markets. The credit quality distribution is to the lower right there, and again the Manistee portfolio is in the blue, and you can kind of see where those lay. Again, the AA's are largely the mortgages and the treasuries. The A's and the BBBs, those would be corporate bonds for the most part there. So again, the whole role here for the fixed income is not just diversification, but getting a reliable income stream that you can count on over the years and complement what's going on the equity side.
I do have a quick question. This is
Questions
Jeff.
On the bonds?
Yeah, I have a quick question. As the bonds that mature in less than a year or within the 1 to 3, will you look to add to that 3 to 5 and 5 to 7 year? Because it looks like it's almost shaping up like a barbell approach right now, and I just wonder, if we don't pick up some bonds in that area, does it leave us exposed a few years down the road?
That's that's a good question, and I'll tell you, the 7 to 10 year block that looks like it's so heavily weighted is where all the mortgages lie, and those are actually more of an average life fixed income investment where some of the exposure in a mortgage is shorter. And so if you can think about part of that tall blue bar in the 7 to 10 is actually residing in the 3 to 5 and the 5 to 7, technically, because as you know, there's a certain amount of people who will be moving within 3 years in a large pool of mortgage holders. So that is not as dramatic maybe as it might look in this picture. But to your point, as those bonds mature that are inside of 1 year, we absolutely will look to fill in those gaps where we see them, whether it's 3 to 5 or 5 to 7. But I think we're kind of maybe also on the cusp of some bonds that are in the 7 year that are about to roll into the 5 to 7. So again, some of this will take care of itself, and for the rest of it, we'll be reinvesting in those areas.
Okay. Thank you.
Yep. Any other questions?
Oh, yeah.
Nope.
Any other questions for Troy?
No.
Okay.
Thank
Great,
you.
thank you. So on the next couple pages, we show you this every meeting, and it's the history of the cash flow distributions along with the oil and gas royalties. And you can see going back to '08, how those numbers play out. And, it's been a marvelous period of time, not only for the growth of the fund, but you can see the distributions, are up, significantly from around 300,000 or so dollars back in, 200 actually in '09 and 10, more than doubling that, and it's kind of going up at a nice rate. I'll remind you that I believe the rate is calculated on the trail. It's an average market value of the last 12 quarters of the fund, and then the 3.5% is applied to that. So this year, I think it's it's close to $450,000. Any questions on the distributions, cash flows?
No.
Thank you. So the last page is the performance. It was, you can see going back, from 1 year to 10 years at the top there. And, we earned about 11% last year. It was a soft year relative to the blend, and primarily because the equities, didn't do as well as the S&P 500. We have some foreign investments, and you can see, how that plays out there. But the fixed income, you look at that line under the asset class section, our fixed income was up about 3%, which just was right on the index of the Bloomberg Intermediate U.S. government of 3%. So that's our benchmark. So overall, we're content with the year. I think once we get into a tough market, we'll show more resilience. But overall, we're pretty happy with the numbers. You can see all those trailing numbers there at the top. 1, 3, 5, and 10. So that's really all we have prepared. Be happy to respond to any questions.
Any questions?
I don't have any.
I don't have any.
We don't have any questions.
Well, congratulations on your pending retirement, though, Troy.
Yes.
Thank you. I've really appreciated working with the folks from Manistee over the years, and I'm sure I'll be checking in with Woody and seeing how things are going, and I'm sure we'll talk about Manistee in the future, and I hope everything just keeps rolling along. I think I look back at when we got involved in 2009 and how far we've come, and it's just been real nice and exciting to be part of it. So I appreciate that. Thank you.
Thank you.
Thank you.
Thank
Well,
you.
I still remember it was 16 years ago, possibly this week, that Troy and I made a trip up to Manistee to present to the board. And I remember, I think there were about 3 feet of snow on the ground. And we stayed at that hotel there down the street on River Street, the one on the river. And it was really something. I mean, River Street was an ice skating rink, and it was just, it was really something. But that was 16 years ago, and it's been a wonderful association, and thanks for all contributions that Troy made.
Thanks.
Yeah.
Woody, I just wanted to mention, we have a new council member on the board, and that's Councilmember Lasky, so just wanted to introduce her as well.
Oh,
Okay, well, nice to meet you, and look forward to meeting you in person in the next, later on this year, probably during the summer.
thank you.
Well, I guess with that, we'll wind it down. Thanks again. Any last comments from anybody?
Nope, I think we're good. Thank you.
Okay. Kelly, thanks for making all the arrangements.
My pleasure. Have a good day.
Okay, bye.
Okay, annual spending rule calculation.
Okay, so if you look at your, I think it's after the minutes, so as Woody mentioned, it's based on the last 12 quarter average. You'll see it's right around 450,000, so 449,825 would be the distribution with the 3.5 spending rule. And the discipline has paid off because it's been kind of a nice thing to have this available, and it does keep growing. I think, do they have a motion to accept
Yeah.
it?
It's a motion to recommend the annual spending calculation as of December 31st for the next fiscal year budget using the 3.5 spending rule.
You want to repeat all that? Okay.
I'll make
Jessica,
the motion to do what Kelly said. Because there's no way I'm getting all that. I
I'll
was
support
good.
it.
Then I lost him.
Is this paid in increments or is it paid annual, or how is this paid? I don't know, I'm new.
It comes out in one chunk.
I believe it's one, yeah.
And
Yeah.
it goes into the capital fund and.
Capital Improvement Fund, I believe. Yeah.
All in favor for that?
Aye.
Anybody opposed?
Motion passed.
Weird to do this with 3 people.
And then I'll just mention that city funds, it is cash we have on hand for the royalties received, and that loan is a Marina Fund loan from several years ago, so that's going to be, Ed says it's going to be paid off in a few years, so just on that sheet there. Thank you.
Annual review of the bylaws, was there any changes? Anybody?
I don't think there was anything that needed to be addressed.
So if there aren't any changes, if you just want to accept them as presented, that's what the motion needs to be.
I'll make the motion to accept the bylaws as presented.
Take the easy one.
Take
I'll support that. All in favor?
Aye.
Aye.
Motion passed.
Okay, April date change. I'm not sure what we were changing.
Well, I'm sorry, that was my mistake when I did the calendar. The 18th is a city holiday. It's our spring day or something. It's right before, the Friday before Easter. So we're closed. So I don't know if we want to do it, either the Wednesday or Thursday before, or if you want to wait till the following Friday. So it would be either April 16th or 17th or 25th or another day. Because I did bring my calendar I know it's hard to look at April, but,
Well, I am gone the last week in April.
okay,
That doesn't work for me either.
okay.
So
Does it have to be on a Friday?
No,
Okay.
no. If you guys want to do it earlier in that week, the Wednesday and
17th?
Thursday is fine.
Like the 17th?
Okay.
Is that?
Yes.
Okay.
So Jermaine, did you make that?
I'll make a motion to change it to April 17th.
All right.
support.
All in favor?
Aye.
And the time change.
And that was you wanted, yeah, okay.
Our thoughts on putting it back to noon
Oh,
meetings? Is that,
that's okay. That,
okay, make a motion to put the meetings back to, does that work for you? I didn't.
That's fine with me.
Okay.
Yeah.
I support.
Okay. All in favor?
I,
I,
Okay.
Okay, motion passed.
Public comment, we have none, so I will take a motion to adjourn.
Okay.
Somebody?
I'll make that motion.
Okay.
Sorry. I was just,
We are adjourned.
thank you.